Hi, hope you're doing well. Welcome back to your second session in this corporate finance program. Presumably you've seen the previous session's video where we discussed what is corporate finance, why is it used, who uses it, where is corporate finance used, and we even spent some time looking at the life cycle of a company, and we talked about how specific decisions are objectively made in the life cycle of a company using the assistance of corporate finance. Now, if you're back here after listening to that video, you probably thought this is worth your time. You want to take this to the next level and learn a little more about the technical details of corporate finance. I'm going to try my best not to let you down and hopefully live up to your expectations. But if you still have questions at the end of the session, feel free to contact me. You will see a contact faculty button in your course page, and feel free to click that and I will answer your question as soon as possible. So constantly in your career as a corporate finance analyst or as an investment banker, you're going to be constantly called upon to analyze a company, to review a company, and to give it your expert opinion on the operations of a company in terms of how is a company's revenue comparing to its competitors, how is a company's expenses doing, are they spending too much money on marketing, are they spending too less money on product development, how is this company profitable, is it very profitable or is it not too profitable, why is it not profitable, why is this company making a loss. So you're going to be constantly answering questions like this at your job, or even it's a great skill to know even outside your job, just to roughly read what the stock market is all about. So all investment professionals, to answer questions like that, questions like what I just laid out, always turn towards this specific financial instrument called an income statement, otherwise called as a profit or a loss statement. Now, that is going to be the focus of our course today. We're going to talk about what is an income statement. The goal of our course today is the income statement. We're going to talk about what is the income statement, what are the different components of an income statement, why is it used, how is it used, and all through the session, it's going to be a short session. So all through the session, we are going to build an income statement as we go forward, so we understand the practical application of it and not just the definition or anything like that. So you probably remember while you were, and maybe if you're like me, a lot of people probably tell you, especially parents, they tell you, write down your monthly expenses so that you know how to plan your expenses better, so you can save money better, so you can reallocate expenses going forward, and all of that. And typically, what would something like that look? If I had a monthly expense book for, let us say, October 2011, I'll say your salary is 1 lakh rupees, okay? And then your expenses, yeah, what are big of expenses? Let's say rent, you live in a nice 2-bedroom apartment in a reasonable city, you pay 20,000 rupees a month on rent, and then let's say food or otherwise eating outside a lot, and you're probably spending 10,000 rupees a month on food and hanging out with friends. Petrol, especially now given all the price hikes, you probably, let's say, spend 7,000 rupees on petrol. And let's say you also bought a flat recently and you're paying down the loan on that. You're paying 35,000 rupees as EMI. And obviously you get the idea, right? There's going to be more expenses down the line. But for the purpose of this, we're just going to stop right here and we're going to calculate what your monthly expense is for October 2011. There you go. 72,000 rupees is your monthly expense in October 2011. So evidently, right, it is very obvious what is the benefit of doing something like this. Every month you can look up and you say, hey, see, I think I've spent 10% of my income on food. I've spent 35% of my income on paying down my EMI. So next month, maybe I want to save more money here. I want to save 75,000 rupees. So I'm going to cut down 3,000 rupees on eating outside. So it's helpful. I don't do it, but it's really helpful. Now, similarly, and before we get to the company aspect of it, what we essentially have here is your own little income statement. Revenue, which is your salary, that's your money coming inside. revenue minus, what is this? Your expenses. That's the money that you're spending that's going outside. Revenue minus expenses is equal to a profit or a loss. So you've been a well-planned spender, so you don't have a loss. You're actually you're actually saving. You're actually saving 1 lakh minus 72,000, which is 28,000. So you're actually saving money. You don't need a loan to go by. So, and essentially right there, that is your basic income statement. Revenue minus expenses is equal to profit or a loss is your basic income statement right there. Now, if it's your personal life, you may not do it, and that is fine. It's not the end of the world if you don't keep your own personal accounts. But when it comes to a company, it is critical that a company, small or big, keeps one of these income statements. Keeps one of these income statements, and the reason for that is it's very helpful for founders to promoters to make strategic decisions on the company. Shareholders want to see what is happening in the company on a quarterly or a monthly basis, and all of that. So let's say you like pizza, and apart from working full-time somewhere, you also run a small pizza restaurant somewhere down on the side. And we're going to build out a very simple income statement for your pizza restaurant. The reason I'm building this out in front of you, as again showing you something already done, is because I just want you to understand that it's extremely simple to build an income statement on Microsoft Excel, and it's not rocket science. So let's start off. We're going to say income statement for pizza company. The name of your company is Pizza Company. It's not very innovative, but Pizza Company for now. And this is an income statement for October 2011. Yeah. Now this is something to remember about income statement, which is that an income statement is always for a specific period of time. What that means is an income statement is either for a month or a quarter, which is 3 months, or 6 months, or 1 year, 1 financial year. So an income statement will always tell you what is happening in that period of time. It's a snapshot of what happens to the company during a period of time. So what is your revenue when you run a pizza company? Yeah, your revenue is essentially a combination of 2 components. One is the number of pizzas sold. Yeah, let's say October 2011 is a good month for you. You have sold 1,000 pizzas. Okay, that also helps us in our calculations, this 1,000 number. And you make really good pizzas, so your price per pizza is 350 rupees. It's a pretty expensive pizza, but I think you will make good pizzas, so that's your price per pizza. So your total revenue, that is the money you have made that month, just like the salary, the 1 lakh the company paid your salary, is nothing but the number of pizza you sold multiplied by the price per pizza. So 3.5 lakhs. That is it. Just like the 1 lakh in your personal expenses, which you got as a salary, which was your income or your revenue, this is the revenue here if you run a company. Then the number of products you have sold multiplied by the price per product is your total revenue. All right, that's a fairly straightforward concept. Now, to make this pizza, what do you need? What do you need to make this pizza? You're probably thinking you need to pay rent for a small restaurant or a kitchen to run to make your pizza and all that. That is true, but then not necessarily, right? You can always make a pizza in your home and you can sell it. You don't need a restaurant to make a pizza. But there's something more fundamental to making a pizza, which is the cost of the ingredients. What goes into making the pizza, right? That is the cost of the ingredients. So, for example, I'm not a chef here, but I'm going to try my best to attempt what goes into a pizza. There is the dough, which gives you the whole crust, the thin crust, thick crust, Chicago crust, whatever. The dough, and let's say it costs 25 rupees per pizza for the dough. So 25 to 1,000 is 25,000 rupees you spend on making 1,000 pizzas. Cheese, so let's say it's about 45 rupees per pizza you spend on cheese, so 45,000 rupees on cheese. You add a nice dash of olive oil because you price your pizza very price, the customer is going to expect that. And let's say olive oil is, you spend 25 rupees a pizza, and that's 25,000 rupees in olive oil. And let's use a bunch of vegetables. You make only vegetarian pizzas, so it's 45 rupees worth of vegetables in a pizza. And I'm sorry, something happened there. 45 rupees worth in a pizza, and 45 into 1,000. See that mistake I just made there? That is something you need to be cognizant about when you're using Microsoft Excel. Always double check your work, that you're not multiplying the wrong number, right? So, and there's probably other things here, but we're just going to sum this up. We're going to sum this up, and we say, there you go. You spend 1,40,000 in the ingredients that go into making a pizza. Now, there is a specific name in finance for the ingredients that are involved in making a product, and that is called cost of goods sold, or otherwise in a short form it's called COGS. Now, COGS is the first type of expense, which is the expense it indicates all the components or the ingredients that go into making your pizza. So now now what happens? You made 3.5 lakhs in revenue, and then you spend 1,40,000 rupees making the pizza. How much money do you have left? You have 2,10,000 rupees, and you guessed it right. In finance, there is another name for that number as well. That is what is called the gross margin. Yeah, the gross margin is 2,10,000 rupees. You had, maybe to make this easier, we should probably write down the formulas here on the side, so it's easy for you to refer if you need to. The gross margin of a company is equal to revenue minus the cost of goods sold, and the gross margin is essentially the amount of money that you have left over after you spend on the ingredients to make the pizza. Sometimes you will add in the labor costs of the employees who actually made the pizza and all that, but those are specific cases. We'll deal with that as the session progresses. As of now, it's just the ingredients of a pizza. Now, you've made your pizza, so what? Are you going to sell it from your house? No, right? You're going to have a nice restaurant in a nice location, so you've got to pay rent. 10,000 rupees per month you're going to pay rent. You'll have to pay salaries. You're going to have really nice hosts and hostesses and delivery men and chefs making your pizzas and serving them, delivering them. Salaries, and let's say you have 5 people, you're paying each of them 7,000 rupees, so 35,000 rupees in salaries. And then we'll have this catch-all bucket called administrative, which will have your phone bills, your electricity bills, your petrol charges and all of that. And let's say 25,000 rupees is your administrative. Again, you get the idea that this is not an exhaustive list. You'll have many more components there, but for now we will just to get the rough idea, we'll stop here. Now, all these expenses, basically the expenses that are not involved in making the pizza, but that are involved in actually selling the pizza. We forgot the marketing cost. Very important for a pizza company, right? These guys keep calling me up all the time and sending me flyers. Let's say you spend 25,000 rupees marketing. All these expenses that go into marketing the pizza, delivering the pizza, making sure the interiors of the restaurant are good, those are called operating expenses, or otherwise they are called overheads. You probably heard this term often. They're otherwise called overheads. Otherwise, they're also called fixed costs. And the reason they're called fixed costs is because it doesn't matter if you sell 1,000 pizzas or 10 pizzas. You're still going to have these fixed costs. You're still going to pay 10,000 rupees in rent if you sell 500 pizzas or 1,000 pizzas. This is a fixed number. You're still going to pay 35,000 rupees in salaries to your 5 employees, irrespective of how many pizza you sell, which is why these are called fixed costs. Now, let's look at what is your total fixed cost this month. It's 95,000 rupees. And that is called, just actually this is your operating expenses. All right. So now You had 3.5 lakhs as revenue from selling the pizza. Out of that, you spend 1,40,000 rupees on the ingredients. You spend another 95,000 rupees on marketing the pizza and the interiors and all of that. How much money do you have left? That is nothing but the gross margin, which is the money you had left over after you spent on the ingredients, minus the operating expenses. You have 1,15,000 rupees left, and that 1,15,000 rupees left is otherwise called the operating income. It's called the operating income because that is the income you derive from the operations of the company. From running the company on a day-to-day basis, you have 1,15,000. Now, you're probably asking me, is that my final profit? Can I take that 1,15,000 home? Not really, right? You can't go home with that 1,15,000 rupees. There's a couple of other things you have to do and spend money on before you actually take that entire money home. The first of that is taxes. We have an entire session later in this program on taxes. So right now we're going to just treat it peripherally. We're going to say you're going to pay 20% of your profits in taxes. So that is about 23,000 rupees in taxes you're going to pay right there. And then interest. Let's say you borrowed 5 lakhs to set up this pizza store. You're paying 10% interest, and roughly that's about 5,000 rupees a month. So 5,000 rupees is your interest. Now, finally, your operating income, from that you take away your taxes and you take away your interest. That is the money that you can take home. That is the money that is otherwise called the net income of a company. A company's profitable, loss, and that's all right there. Let's just go back here and just write down a couple of more formulas. We got the gross margin right there. Operating income. Operating income is nothing but the gross margin, which is the money left after you spend on the ingredients, minus the operating expenses. That's your operating income. Net income is essentially operating income minus taxes minus interest. Now, I must warn you, you can't, take these formulas to quote. I mean, they work for our reasons right here. They are right. But then as we go along this course and when we explore bigger and more complicated companies, you'll notice that there are more items that come into here. And so these formulas will slightly change. But then for a basic understanding, this is good enough. Now, there are some other names for these things, like net income is also called PAT, or otherwise it's called profit after tax. Now, if you didn't have an interest, this operating income could otherwise be called PBT, or profit before tax. Essentially, your profit before you paid your tax rupees. All right. So now, let us, just to make sure you get the concept of gross margin and net margin, we're going to look at an example. Two very popular companies, Amazon.com and Google.com. Amazon.com's gross margin is 24%, whereas Google.com's gross margin is 65%. Now, if anybody who's not very well versed in finance is going to look at this and say, oh my God, Amazon is a terribly run company. Their gross margin is 1/3 of what Google's is. But you, being a corporate finance professional and having learned what a gross margin is, you will know that just because their gross margins are different does not mean one company is worse than the other company. No, Amazon.com is the #1 e-commerce company. Google is the #1 search company. And both are outstanding, world-classly managed companies. The reason Amazon's gross margin is only 24% of their revenues is because, what does Amazon sell? Let's say books. Is an e-commerce that sells books. Let's say the average book costs $10. They sell a book for $10. How much do they keep out of the $10? A typical book probably costs Amazon about $5, $6, right? So out of every $10 they sell, they only get to keep $4 or $5, if not lesser, based on what categories of products you're talking about. So whereas when you come to Google, Google is a search company. They make all their money when you click on those advertisements in your search results. So let's say every time you click on that advertisement, let's say the average advertisement is $5 a click. The advertisers are paying Google $5 a click. For every $5 Google takes in, Google has very little expense to serve those ads. It's not like the Amazon book. They have not very little expense. All the expense to serve that ad is probably some electricity at some server farm going on, a bunch of computers that's processing the search requests. That is very minimal compared to actually the cost of a product like a book, which is why most of the money that Google gets as revenue, Google gets to actually use it as an operating expense in terms of R&D, giving their employees free food, having fancy offices, getting into 500 different other products and all of that. Whereas Amazon doesn't have the luxury because they're a much lower cost of goods gross margin company, and that's not a bad thing. Retail is always a low gross margin business, but it's all about efficiency in retail. That being said, now let's say you went to a restaurant like this with your parents, right? Something like this. It looks pretty fancy. I can already see, I'm going to sit down at this table here with my mother and I'm going to order, let's say, paneer tikka. Now, it looks like a really fancy restaurant, so I'm going to assume a paneer tikka plate here is going to cost about 600 rupees. My mother's going to find out that plate of paneer tikka costs 600 rupees, and she's going to go, oh my God, a plate of paneer tikka is 600 rupees. Imagine how much profit these people are making. Okay, let's stop there. Now, when she says, imagine how much profit these people are making when it's only when they charge 600 rupees for a plate of paneer tikka, the thought process that's going through her head is she's thinking, paneer probably costs 50 rupees max. Maybe they import their paneer, fine, whatever. 50 rupees. Their tikka, masala, oil, and all that stuff put together, another 50 rupees. So 100 rupees is the cost of making this paneer. Why are they charging me 500 rupees extra? So you realize what I'm trying to get at. When she says they're making so much profit, her expense calculation is stopping at gross margin. The cost of the paneer, the cost of the tikka and the masala and all of that is the cost of the ingredients, the cost of the gross margin. What she's not taking into account is she's not taking into account this, fancy lights up here. I've never seen lights like that in a restaurant. All these great ceilings and walls, the carpet, fancy chairs, maybe, white gloved hosts and hostesses serving you stuff. The operating expenses she's not taking into account. She's just taking into account the cost of the food and telling you it's a great gross margin. So next time you take your mother out and she tells you something is so expensive, you can actually explain to her the mistake she's making. Okay, maybe she just won't agree with you it's a mistake, but you can try anyway. Now, let's say you are passing in front of a restaurant that looks something like this. There's a fancy restaurant, there's some flags here, looks like a fancy road, and there's this huge limousine car parked outside where, they take their guests home late night if they can't get home by themselves, okay? So you probably noticed, you probably walk by a restaurant like this or a hair salon in a really posh area, and I would wonder, how do these guys make a profit when they're located in an area like this? They have to pay so much on rent, they have to pay so much on like insurance, taxes, and all kinds of stuff. How do they still make a profit? When I say that, I'm actually talking about the operating expenses, because I don't even know what the restaurant sells. I don't know what their menu price is. I'm making a judgment saying they have to pay so much in rent. They have to buy this huge limousine car. The rent and the cost of the limousine car are not cost of goods sold that contribute your gross margin, but they fall somewhere here, which essentially contributes to your operating expenses and your operating margin. So here I'm actually talking about their operating margin. So now, hopefully, you have a fairly good hang about what an income statement is all about, the different components of an income statement, why is it used, the different terminologies used, and you even know how to build a very basic income statement. Yeah. So in the next session, what we'll actually be doing is we will still stay with the income statement, but we will take a special case of the income statement and we'll talk about special scenarios and revenues and expenses like revenue recognition, accrual accounting, and cash accounting. And we'll also focus on some financial ratios that will help you analyze an income statement better and actually make an intelligent call or decision on the operating efficiencies of a company. That is it for this session. Thank you very much. I will see you soon in the next session.